I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ross Kay from thewealthyhomeowner.ca. He's a real estate expert. Welcome back to the show, Ross.
Hey, thanks a lot, Jim. Thanks for having me.
Canada's realtors announced their monthly stats for the country. Ross, they claim home prices are up only 0.44% versus this time last year. Should we really be looking at those numbers with a grain of salt or two?
Just take the salt shaker out, take the lid off, and pour it on it. I'm watching, we're at the office here today, and on these days we always have the TV up with BNN on, and their guys are always checking their feeds to see what kind of real estate news is coming out. And the amount of commentary out there today on this housing report, this sales report from the Canadian Real Estate Association, probably has reached an all-time high. Now, I think I probably said that on your show before in the past, but today is a monumental day in terms of how the Canadian public has been deceived, openly, blatantly, willingly deceived by organized real estate. And it was really capped off today. What you didn't hear in any news report today was that the extreme lengths the Canadian Real Estate Association went today, in today's report, the extreme lengths they went to have a positive 0.44% gain year over year. In other words, they were so desperate not to say negative, not to say that house prices have dropped a penny, that they went to some extreme lengths. If your listeners, this is asking too much for the average listener. If you were to go on the Canadian Real Estate Association press release from last year at this June, you'll find out what they've done this year is they've adjusted the selling price from last year down by $633. At the same time, they included sales from this year that were double counted because of the way the real estate boards reported them in the month of June. Now, whether the Canadian Real Estate Association is aware of double reporting, I'm going to say they're aware of it, they just don't care. The backdating of last year's numbers and lowering them, they do that on a regular basis. But that was how important not saying negative, not using the word negative, was to create that 0.44% increase. What I'll tell your listeners is this, is that all of the analytics that we've been giving out are being proven 100% true. As I say in the show, they're being proven true because they cannot be avoided. This is how a housing market functions. The Canadian national housing market has been contracting for 11 consecutive months, except the only people in Canada who know that is Ross K. Realty Consultants. We're the only people who know that. Housing prices did not increase 0.44% nationally today. They actually decreased. What the Canadian Real Estate Association never tells anybody is when a housing market starts to correct or contract, that we're almost into the correction phase now of the Canadian national market. Certain sales in certain segments of the market drop off first. And that allows the illusion of house price growth to be maintained for a few months. You're seeing that out in British Columbia today, in Vancouver, where the contraction bump from May, June, and probably still going into July. Nobody knows about it, but it's one of the metrics that we measure. People don't understand what's happening with the market. That's exactly what happened with the Canadian Real Estate Association today. We're going to be updating our own Canada-wide metric and explaining to people what exactly happened today. What your listeners can understand is this. The average selling price in every single province, except Saskatchewan and Newfoundland, increased more than the average selling price in Canada during the month of June. That's right, folks. Every single province in Canada had a greater year-over-year, month of July, house price gain, except for Saskatchewan and Newfoundland, two of the smallest provinces representing less than 2% market share of the entire country, than Canada did. The Canadian Real Estate Association, because for the last 10 years have used faulty numbers, they couldn't go back today and say all of a sudden, oh, wait a second, we were caught. We can't flip. When you're using housing metrics that measure the market on a consistent apples-to-apples comparison, which is not what a benchmark price is, which is not what the house price index does, you need to be looking at all of the components of a housing market, putting them together each month exactly the way the housing market is functioning. Then you know that what happened today was the average selling price actually dropped. This is the first full drop, well, actually the second full drop. They dropped last month too, when you do the way that we calculate them. But it is that 0.44%. The mere fact that they would say it's 0.44% should tell all of your listeners, you cannot believe realtors. You cannot believe. We saw today, Jim, where the RBC is now forecasting a 6.7% national house price increase during 2017. As of today, they get these lower numbers today. They're still suggesting, as of today, that there's going to be a 9.7% increase in 9.6 in 2017. It's impossible, folks. It will not happen. It is impossible. The housing market would have to flip on a dime and start to build such velocity back in the market to make up the difference that has already been taken out of the market. That's what got released today, Jim. They came right out. They did everything they could to have a positive gain, and every single home buyer who is going to go out and buy a house in the next month or two, believing this nonsense, is making arguably one of the worst financial decisions of their life, because they're making a decision not having the true data.
We'll have more with Ross Kay right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross Kay. Ross, I saw a crawl on the TV set that said a 6.7% decline in May to June sales in Toronto was the biggest monthly decline in 7 years. Are those correct numbers?
Drops in sales volume. No, that isn't the truth. Okay, here's how I word it to you this way, Jim. If I told you that one month dropped 15,000 sales month over month, and another month dropped 9,000 sales month over month, which of those 2 months would you say had a bigger drop?
Don't let my mind do math.
Right. You would say the one that had 15,000 fewer sales. Not 9,000, 15,000 fewer sales. That's what I would say. And that's what I think anybody that has a calculator would say. That's not what the Canadian Real Estate Association says. That's because in 2013, when the housing market tested a correction, as the cycle was reversing, for 3 months in 2013, there were fewer sales in that month of 2013 than there were in 2012, with a greater difference than we just recorded in June of 2017. You do not have to go all the way back to 2010, like the Canadian Real Estate Association told you. You only have to go to 2013. Why this matters is this. They conned everybody by misrepresenting what those sales declines in 2013 were actually recording. Those sales declines were predicated on higher interest rates hitting. When those higher interest rates started, we started to, on the end, towards the end of the current trading cycle. In other words, the market had troughed in terms of sales, and sales, the only way sales could increase is if trade-up buyers gained a larger share of the sales every month. Fewer first-time buyers were participating in the average selling price. That culminated in the month of April at the national level in Canada this year, which is where you had those highest house price gains in the Greater Toronto area. You didn't actually have higher house price gains. What you actually had was fewer first-time buyers and more trade-up buyers being lumped together and coming up with an average. Obviously, if a whole bunch of people are buying $1 million houses and fewer people are buying $100,000 houses, or even $300,000 or $400,000 houses, your average is going to increase. That's the only way you can get these crazy numbers that they're talking about. So if you're using housing, if you're making the largest financial decision in your lifetime, listening to these guys, you're making a massive decision. And this is going to be exposed, folks. This is going to be exposed. Because what we have now is first-time buyers have started to re-enter the market. And when first-time buyers re-enter the market, guess what happens to the average selling price? It drops. The reason why we use a metric called days owned between trades, which tells us how many days the average homeowner has been in their existing home before they're moving to their next one, is because that allows us to calculate how many first-time buyers are coming into the market. That allows us to understand house price growth illusion, which we also would call a housing bubble. Any of your listeners who question what I have to say only needs to Google fooled by search, FOOLED by search, by the Bank of Canada. And you are going to see a Bank of Canada economist who did research on this back in 2009, where the research was almost right. The only problem for the Bank of Canada and everyone else out there is they didn't have the experience to be able to bring the other components together to prove that thesis that the fellow was writing for the Bank of Canada. The author of that thesis, excuse me, he's correct. Fooled by search is a technically correct comment. We call it a house price illusion. And anybody who wants to question that are house prices really able to go up, what everybody's telling you they can go up, only needs to go read this report by the Bank of Canada. Because the author explained it. He just didn't know that he was explaining it. He was explaining something where he didn't have the other metrics to fully test his theory. We have those metrics. We know that over the course of a trading cycle, The real house price never increases. It's the sales mix that change that creates house price illusion. It's why we tell everyone when you're purchasing a home, it needs to be on a 25 to 40 year outlook so that you don't get caught in this house price illusion. It means that as long as you own it 25 to 40 years, you're going to come out in the other end getting your between 3 and 6% annual rate of return, cumulative and compounded annual rate of return, depending on which province that you live in. There are many components that dictate how that's going to work, but a short story is that's the only gain you're going to see over the long term. What allows that gain to happen is house price illusion. And then we have a correction. And the correction wipes out the illusion. And it starts all over again. The Bank of Canada identified it. Fooled by search. Google it, folks. Fooled by search.
We'll have more with Ross Kay right after this.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Ross Kay. Ross, of course, the Bank of Canada increased their trend-setting rate last week. How could that impact the market, and how long would it take to see any of those changes?
Okay, so the Bank of Canada raising the interest rate a quarter of a point. Okay, what your listeners don't understand is the banks already did this themselves back in November. Back in November, we had members who were locking in at 2.09. Actually, some got 1.99% for a 5-year mortgage, but generally speaking, the best rate was 2.09% on a 5-year mortgage, and that was commonly being achieved by people following our advice. So those people were locking in at 2.09%. What the banks did is they reduced the mortgage discount that they give on a 5-year rate. That mortgage discount went from caused rates to go from 2.09% up to 2.42% by about February. The reason why you've got that surge in sales during the month of March and April, and for people out in British Columbia, Vancouver, June and July, is because people still had those interest rate guarantees from the earlier times, back in November and December, of 2.09%. They had to purchase a house quickly enough to be able to capitalize on that rate. What we're seeing now is those trade-up buyers that had secured those great rates at 2.09% are leaving the market. Well, they're leaving the market, and there's not new buyers replacing them. First-time buyers now are coming back into the market, even though interest rates are because of the discount was reduced, are coming in. But it's the first-time buyers that are coming in are purchasing a little bit lower-priced homes to make up for the difference of the interest rate. So we've already seen a discount rate change of 0.25% from way back in November hit the market. It hammered the market. You're reading it in the newspapers today, how hard it hit the market. Now we're going to have another wave, another 0.25% increase. We do a calculation for homeowners, and that calculation tells them how much their house is going to, the cost to own their home. We don't talk about principal payment repayment. We talk about how much the actual cost is to own their home. We know that a 0.25% rate rise in interest rates from 0.5 prime to 0.75 prime, which is what the Bank of Canada did, it raises your cost of ownership by 11%. 11%. That little tiny increase. That's because that little tiny increase in on a 2.5% mortgage is way, way bigger than you put on a 0.25% increase on a 10% mortgage, like we did at the last time when the housing market corrected. So when people talk about interest rates, we also know how the sales chain works. So the sales chain is, if the first-time buyer pays less, it's not only a drop in what the first-time buyer is able to spend on a house, but it's the impact on each successive buyer in the sales chain. We call that the multiplicity of sales. So the multiplicity of sales, which causes house price illusion on the way up, it causes more rapid house price depreciation on the way down. It's important that everybody knows exactly where the real value of their home is and what impacts these interest rate changes are going to have on the housing market. Because if you're going to buy a home and you don't do this at the right time, in other words, you were foolish enough to listen to all the realtors and buy in March, April, and May, you are now finding out they lied to you. Now, they may not have knowingly realized they were lying. They may have really believed house prices were going to go up forever. But the real data, the real knowledge, the real metrics prove that is an impossibility. It is impossible for housing prices to continue to go up.
Well, we've heard all these different headlines. Oh, that little hike won't make any difference. Others are telling us, my God, it's financial Armageddon. You're not going to be able to support anything in your lives. What should we listen to, and what advice do you have?
Okay, so again, self-serving. What advice do I have? A, do not listen to a realtor, a banker, a mortgage broker, a financial advisor when it comes to your house. They know nothing. We have proved over and over again, we have not made a mistake. Our metrics cannot, it's just that they can't be wrong. This is how black and white housing markets function. You need to have some independent advice that is not tied to selling you something. The real estate agents very quickly are going to be jumping back on the sell bandwagon. Sell now before housing prices drop, because they want to make commission. The same way that for the previous 13 years, they told everybody, buy now because housing prices are going to go up. They switch to whichever market they're working in, because if they don't make sales, they don't make any money. Your financial advisor generally does not want you to invest in housing. He doesn't, or she doesn't. They want the money to invest in the stock market so then they can get a cut of it. Okay, I don't have a problem with that. I'm just telling you that's the reality of it. The reality of a housing market is this, and I really hope all of your listeners, especially the 30-year-old listener who's out there listening, I'm not going to tell you to buy a house right now, so don't take this wrong with what I'm saying. But we have what's called the Freedom 55 plan. The Freedom 55 plan. The Freedom 55 plan is this. When you're 30 years old, even though I know you can't do it, go buy $1 million house. Because by the time you're 55, as long as you paid off your mortgage, you're a millionaire. And then with the strategies that we have available to us today, not only are you a millionaire, you can take out $300,000 cash, and you can have a guaranteed monthly income of over $5,000 a month. That's how simple it is. And when you really sit down and look at it, it's way, way better than that. So now you've got to own your house in the right way. You've got to do everything in the right way. You've got to maximize everything. Because again, would you rather have an annual rate of return of 0, an annual rate of return of 2, or an annual rate of return of 5? It's up to you what you want. But the difference is, The only difference is how you own your home. There's no added risk. Whether the housing market corrects or not, it doesn't matter. There's no risk in these type of approaches. You don't have to believe me. You don't have to believe us. Call your lawyer, call your accountant, call your financial advisor, call them all and ask if anything we're saying is wrong, because it's not wrong. This is just simple math. You really should not be buying a home when housing prices are falling. We just heard today, nationally, housing prices are falling for the first time. That's the first time your listeners heard it, unless they believed us. We've been saying it for 11 months. The Canadian national price has been in a Canadian market has been in a contraction. We are now moving to a full-blown correction starting sometime next month. Next month will be a full-blown correction. We will call it ourselves 2 months after that. All the people who've been listening to us in the past, they had 11 months notice on this. The homeowners or home buyers are looking at their dashboards every single month, and they've been shaking their heads wondering, why do they keep saying that the housing prices are not going to be up in the next 6 months? They're saying right now house prices are going to be up 2 months from now, but then 8 months from now they're telling us our house isn't going to be worth the same amount of money. We're able to say that, and now they're realizing, now we understand it's true. The reason we're able to say that is we know how a housing market turns over. We know how house prices rise and fall. So you're able to forecast way, way, way ahead of what you end up reading in the newspaper. So when we're sitting here today, we're looking at a gain. Right now, we're looking at, if you're lucky, there'll be 0% gain in 2017 national. So in other words, by the time December rolls around, or actually January the 15th, of 2018, when the Canadian Real Estate Association, for the first time, tells everybody what the average selling price was for the entire year of 2017, that number will be exactly the same as the one that they released. Odds are it's not going to be any higher than the one that was released last January 15th of 2017, this year. So a full year later, the house price is going to be the same. It isn't going to be up to 10% that the Royal Bank of Canada told everybody today it's going to be. It's not going to be up to 12% that Royal LePage says. It's not going to be up the 8% that the Canadian Real Estate Association is saying. It is impossible for it to reach that number, folks. There cannot be enough debt. There cannot be enough debt acquired in this country to make that happen. We're going to have a correction of some sort. The magnitude of, we will be reading months and months and months ahead. So when this market prices start to go back up again, we're going to know months before everyone else that those prices are headed back up. But what I'll tell you right now is, prices are headed down.
Ross, thank you so much for chatting with us.
Thanks a lot, Jim.
My guest has been real estate expert Ross Kay from thewealthyhomeowner.ca. You're listening to HoweStreet.com radio. Questions for the show or our guests can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.